Welcome to Trading Nation. I'm Mike Santoli. The Fed leaving rates unchanged and actually had a dovish surprise for the markets. Let's get more on the decision and the market reaction from Victoria Fernandez. She's Chief Market Strategist at Crossmark Global Investment. Victoria, good to see you here.
Thanks for having me, Mike.
So, yes, the Fed kind of delivered maybe what investors were expecting, perhaps a little bit more dovish than expected. How does it fit in general into your investment outlook for this year?
So we had expected that we would have one rate hike this year. So that fits in with the narrative that we would expect. I am surprised that they went down to zero on that. To me, that is more dovish than what we were expecting for the rest of the year. I find that a little surprising. I think we have enough momentum going on in the U.S. economy that it would warrant possibly doing one more rate hike later in the year. Again, that can change. We know it's not written in stone, but that's a surprise to me.
What about the other factors that are driving things? I mean, if I guess on the worry list of investors, the Fed was somewhere near the top of the list a few months ago. Maybe it's no longer on the list. What else do you think the market faces in terms of hurdles and opportunities? Yeah,
so we obviously have some uncertainties, right? And the biggest two things on that are going to be Brexit and the U.S.-China trade relations. So there's a lot going on with both of those today. Brexit, if we get an extension, if Theresa May gets the June 30th extension she's looking for, that takes a little bit of uncertainty out of the market, gives a little bit more room to come to a final decision. So I think that would work well. U.S.-China, that's kind of up in the air again today. We saw the market do a big reaction with Trump speaking earlier on that tariffs may stay on. Again, that's going to just cause more concern about global slowdown and how that feeds through emerging markets and then back here to our shores.
Does that undermine where the markets have gotten to this point? I guess I'm asking, look, S&P 500 up 12, 13% at the high so far this year. Bond holders have done well too, right? I mean, bonds have rallied. So generally, portfolios have been in good shape going into the end of the first quarter. Is that vulnerable now, or how does it play out?
I think that there is some vulnerabilities there. For us on our fixed income side, we've actually taken a very conservative approach lately, a short duration approach. So having yields come down works against us a little bit. We anticipated we would get a little bit closer to maybe that 2 3/4 range. But on the equity side, we're finding places where we can take advantage of movements in the market. As long as we have some tailwinds to keep pushing us, that works to our advantage. If we have a big pullback, that's going to change our outlook a little bit, especially in our options trading. We'll pull in those options a little bit shorter than where we are right now.
Did want to get to one move that you did make with regard to one of the big tech names, Facebook. What's been your posture there, and what is it now?
So we always saw Facebook as kind of like a long duration bond. That's how we looked at it with their cash flows. So when it pulled back, back at the end of 2018, we saw an advantage to go in. It'd been trading at about, 24, 25 times. It came back to around 17.5. So we saw it as an advantage to kind of dip our toe in Facebook. So we added a little bit, about 1% to our portfolio. As we're watching the headlines and things going on with them now, we'll just continue to see if we want to add to that or if we're good where we are. But that was just a little addition that we made after the pullback at the end of December.
Well, you're ahead on it so far, so we'll see how that goes. Victoria, thank you very much.
Thanks, Mike. I appreciate it.
And thank you for joining us today. Thanks for watching Trading Nation. I'm Mike Santoli. We'll see you next time.